Hey, Gentry. Hey, Katie, how's it going?
Hi there, we're great today.
Going great for a Saturday morning.
Thank you. Hey, I wanted to talk about opening an account with all this money Alan pays me to do the work. How do I get a tax ID number? I'm not a single and I'm not a married. I'm a puppet.
I'm not sure the IRS has a category for puppets. I need to look into that.
Yeah, and if I die, do I go through probate or do I need to set up a trust? I'm not really clear on that. Do I have the same property rights as a tree?
Well, we'll have to touch on a few of those things today. I hope
Okay.
Alan's already done your estate plan for you.
My documents are so complicated it would make your head spin.
But Alan does a great summary and wonderful flow charts that makes it pretty easy to understand.
No, I made those. He doesn't do a darn thing.
Now we know who does the real work, right?
Right. Okay, you go to bed or do some work. All right, bye-bye. I'm gonna put him down here. Don't put me down like that. All right. It is Saturday, August 26th. Welcome to this presentation entitled Florida's First Female-Owned Trust Company, and a lot of really interesting things relating to that. I've got my friends and colleagues, Gentry Burns and Katie Pimble, here with me. I'm going to go through a few preliminary things, and then we're going to sail through some very, very interesting materials. I was looking through the PowerPoints before, and they are darn good. If you came in through CPA Academy, you will get 1 hour of continuing education credit if you're a CPA or an enrolled agent or an alien from outer space. You have to be one of those 3 categories, and then you'll automatically get this credit if you answer 3 of the 4 polling questions. So stick around for that. If you came in through our portal, if you're a Florida lawyer, you'll get continued education credit. Just ask us and we'll send it to you. Otherwise, you're out of luck and you should go play golf or do something else like that. If you have a question, click on the upside down pyramid, stand upside down or type upside down your question, and then we will look at the question and we might even answer the question probably towards the end. Later on today, you'll get an email from us and you'll be able to click it and watch this presentation as many times as you like, or you'll be able to go to YouTube to watch the presentation. Now, when you go to YouTube, please go to settings and click on HD to give yourself the highest quality so you'll be able to see the screen correctly. At noon, when this presentation is over, Professor Jerry Hesch is going to join me, and I'm going to give Jerry a walkthrough of where we are with the Estate View estate tax planning software. It is free of charge, at least till the end of this year. You can just go to estateview.com.link and put in your email address as test@test.com, no capitalization. We're not capitalizing yet either. Then the password is test, T-E-S-T. Then you'll be on it, and if you watch us at noon, you'll see how to use it, and it's got a lot of neat things. So that's Jerry Hesch and I at noon. That's in 58 minutes, but it may seem a lot longer. And I'm going to start, before we start, with the first polling question. The first polling question, and we've given you no information, so you're going to have to be really, really intelligent here. What does a trust company really do? Number 1, it will decide whether your great-grandchild will get a Porsche or braces. Number B, it will provide investment management. C, it will pay bail bonds for beneficiaries so that they won't have to pay them themselves. D, it may do all of the above. Or E, I have no idea. That is why I am here. So Josh, let us know when we've got that polling question handled. Okay. All right. There we go now. So this is big news, waiting for Katie and Gentry to come back. Do we have your bios anywhere? No.
I think so.
I don't believe we included them.
Forgot that. Okay, well,
This is all
I'll-
about education, Alan, not about us.
right. Okay, well, I will introduce Gentry, and then Gentry will introduce Katie, and then Katie will introduce the subject. How's that?
Oh, perfect.
Gentry Burns is a talented and experienced trust and estate lawyer. She was with one of the most notable firms in the St. Petersburg area for a number of years. She then went to work for Bank of America Trust Company, as I recall, and then got promoted to Raymond James Trust Company, as I recall, and has done a fantastic job managing not only trusts, but managing trust company operations. So that's a great, great talent. She's good with the law, she's good with people, and she's got great goals. And now Gentry's going to introduce Katie.
Thank you, Alan. And Alan and I have been friends for a long time, and call him regularly when I have a tricky situation or want to bounce an idea. So I always appreciate that you give me great advice. And Katie and I actually worked together for a short period of time at Bank of America. She ran the commercial division for the Tampa Bay area and was the area president. And we were on the same floor. And while we didn't have the exact same role or same clients, we got to know each other, and we've known each other ever since and followed each other's career. Katie went on to do some fantastic things in community banking and was the CEO of two community banks here locally in the Tampa Bay area. And I'm so excited that she's my partner. Katie, I'll let you tell a little bit more about yourself and introduce our topic.
Thank you, Gentry. Thank you, Alan. Gentry, I think you did a great job introducing me. I don't have any more to add other than we're delighted to be here. Alan, I really admire you inviting us on the show on the same day as National Women's Equality Day. Yes, it's really, really special for us. You know, interestingly, it's also the day after the 50th anniversary of the tennis battle of the sexes. And you might have an audience online that wasn't watching television or watching tennis in 1973, but Bobby Riggs had challenged, or maybe Billie Jean King had challenged Bobby Riggs to a tennis battle of the sexes. Bobby Riggs was a self-proclaimed chauvinist and did not think that women should be earning money to play tennis professionally. Billie Jean King won that match, and the two of them went on to be fabulous friends and work towards women's equality in our nation. It's interesting also that in 1972, 1 year prior to that, was the first year women were were permitted to have a credit card or debt without a male co-sponsor or co-borrower. So we've come a long way, Alan, and we are grateful for all of those men in our lives who have supported our advancement and having a seat at the table. So thank you. So yes, Gentry and I took the bold step of forming a state chartered independent trust company in Florida. When we began and said, why would we want to start a trust company? It was really the business case that led us to that. And I know some of your listeners might be interested in how does one go about starting a business like that? And it does start with, do you see a need in the market? And then do you have the qualifications to meet that need? How would you go about that? Establishing that business plan, and then honestly, just having the grit to move forward with it. And that's what Gentry and I have done over the last several years, just planning and thinking and doing research. And what we found is that there was an overwhelming need for trust administration, fiduciary investment management, and financial planning advice. And that that need was ever increasing. And it was increasing in a way, the demographic shift of wealth transfer in our country was leading 70% of that $30 trillion or $50 trillion of wealth transfer over the next 10 and 20 years would be in the hands of women. So the face of wealth was changing. And then the demand for fiduciary services and a goals-based approach to investment management is becoming just increasing. We also saw a need for women to have a greater financial self-confidence. All of these things I've just mentioned with demographics is well documented, and whether that's the McKinsey studies or Wall Street Journal reporting. So I should have had a link here, but anyway, well documented demographic shift. And then we also saw that specifically in Florida, bank-owned trust companies were consolidating out of state and raising their minimums. And they're raising their minimums because so often people think of trust as merely a tax planning strategy to mitigate their estate tax, when really there are so many more reasons to protect a family's wealth. And so we saw a void with banks focusing on or having a $10 million minimum in investable assets. And then I guess thirdly, what we really just wanted to convey is Gentry and I both have had 30 plus years of a career here in Florida and Gentry nationally. But we always have come back to our passion about protecting our clients' current wealth and protecting our clients from seemingly small decisions that can have outsized impact. And women in particular want to focus on this generational and this legacy planning. And we want to focus on helping improve what we're calling, and I think others have called it too, I don't think we've created this name, but this wealth health. So that's why we've started Adelphi Trust Company.
That's fantastic. And
well, thank you.
And when did
yes,
you
go
open,
ahead.
I'm sorry, when did you open the doors?
So it's a great question. We received, I'm going to answer in a little bit of 2 sentences though. We received our Florida Trust Company charter August 15th of last year, 2022. So we just celebrated our 1-year anniversary of our company. We opened the doors, yay! We opened the doors 8 weeks later in November and have had 10 consecutive months of growth, both with clients, new relationships, and of course, ever important growth in revenue and profitability.
That's great. And what has surprised you most since you opened the doors?
You know, I'm going to let Gentry talk about that because we thought the business would start out for the first couple of years a very specific way. And we've been delighted at some of those differences.
Yeah, so Alan, when we established our performa and, you know, really thought through the clients that we would onboard in the first year, we thought the first year and really the first 2 years would be mainly investment management. You know, clients that are moving their IRAs to us that we've known, friends and family, our shareholders, and we did not even have our first trust in our performa until year 2, which is kind of funny since we're a trust company. But trust sales, as you know, Alan, it's a longer sales cycle. It's a longer process to work with the attorney on getting the document prepared. Often it is working with the client on something that's not going to take place until the future. We're named to step in when the client becomes incapacitated, or at some point in time when maybe a special needs child or somebody needs to be taken care of, or even at the death, settling the estate. So a lot of times when we're talking to clients, it's for something in the future. We were greatly surprised that about 30% of our accounts right now are trust accounts. You know, our very first 2 accounts that we opened were charitable remainder trust. And so we shifted a little bit in how we were working with those clients and how we were building the business, because we hadn't quite prepared for that many trust accounts in the first year. I'd say the other thing that's been shocking is how much time it takes to run the business as opposed to doing trust administration, right? Trust and investment management. And so that's a balance that Katie and I have to, we balance that every day. And so we've added additional people to our team and already are planning to add 2 more in the next 6 months, so that we have that ability to continue to provide that white glove service that we're already providing to our clients in the first 10 months.
Oh, that's fantastic. That's great. Good news. Okay, what are we covering next?
Well, let's go to the next slide. A lot of people have asked us, what is the difference in owning in a woman-owned trust company? It's been well documented that women make financial decisions differently than men. They approach the goal differently. They approach the very specific parts of preparing for financial health differently. So here are a few that we thought we would touch on here today. And I think the first bullet point is sometimes surprising to people, because certainly men also deserve and demand a high level of personalized service. But it's a little bit softer type of personalized service while still demanding high level. So Gentry mentioned white glove. You can see our offices are more like a living room, if you will, and that is appealing to people who are coming to see us. Also, women, seek financial advice, focusing on their individual goals. So they want us to start with that discovery of goals, and they want it to end with, here are the decisions that you need to make along the way in either 1-year increments or 10-year increments, and helping them see decisions they make now, 30 years from now, the impact that can have for their family. Generally, women are less risky. They don't want a ton of volatility. They want some steady eddy, if you will. They do seek fiduciary advice. They want to know that the advisors they're working for are required to put their interest ahead of our own corporate interest at all times. And we'll talk a little bit more about how we do that and how we're governed to ensure we are always a fiduciary. Women do their estate planning earlier and more frequently than men. And women, again, this is all well documented and it is generalization, but women are charitable and community inclined. They want to make an impact early, and not always once they've completed their financial goal.
Wow, that's interesting. I guess it's things that you think you know intuitively, but you think about it, it's good to remember these characteristics, how people think differently.
Yes, well, thank you for recognizing that. We talked about it a little bit ago, this generational shift or this demographic shift of wealth. And so all firms are focused on these types of things. And Gentry and I just figured we've been doing this and working with our clients in this manner forever. And, we wanted to not only continue to serve all of our clients with this personalized and focused way, but we also wanted to take part in and be an inspiration to other women who are at senior levels within their companies help them see that they can make it to the next level, if you will, or place in this industry, including ownership and leading an organization. So we hope that we're doing that as well.
Okay, let me ask you, I don't know if this is the right time or if it's ever the right time to ask a question like this, but so often we are in a conference room with a man and a woman, typically known as a married couple. And the man is more likely to be leaning forward and more in control of that married couple's decision making.
Absolutely.
So sometimes it's hard to know what to communicate for the more passive partner in that room. And I'll point out also, by the way, that we have a lot of men who have over the years preferred a female lawyer when working for us, because men feel that the female lawyer cares more. And statistically that may well be correct, but how do you handle the married couple communications? Do you handle it differently than the typical advisor?
Well, I think Gentry and I will both answer this. Alan, I'm so appreciative that you asked the question, and you prefaced it with, I'm not even sure this is appropriate. And I think if we all can talk about these things, because sometimes they're just blind spots. It's not really any bias, it's just a blind spot. So the more we talk about it, the better. And Gentry, I don't know if you want to touch specifically on Alan's question and how we see it and experience it.
Yeah, so I think every woman that we have talked to has experienced this at some point in time in their life or in their career, where we now have a seat at the table, but often don't feel that we are heard at the table. And I can just tell you, so many clients that have told stories from everything from buying a car to dealing with the garage door repair person to dealing with their financial advisor, where they feel that the advisor or the car salesman or whoever it is only speaks to the husband and does not ask the wife what her thoughts might be, or lets her weigh in on the decision making on the financial plan, the estate plan, or what's important to her. So whether it is just a bias or the way we've been doing business for all these years, I think it's important for every advisor, every attorney, financial planner, CPA, when you are sitting across the table from that husband and wife, to make sure you ask the wife, is she comfortable with what's being discussed? What other thoughts does she have on the estate plan or the financial plan? What are her goals that she wants to accomplish in the meeting today? Even, Alan, you said so often that wife may be the passive partner, maybe not speaking up, but if you ask the question, what would you like to accomplish today? You would be surprised at, one, how genuinely excited that the wife might be that you are asking what the purpose of the meeting is for her and what her goals are. And you will have a more loyal client at the end of the day as well. And you also may find that what you thought were the estate planning goals or the financial planning goals, whatever it is you're talking about with your client, might be different for the wife than what it is for the husband. So it can, create some really good dialogue as you're putting the plan together.
Beautiful.
Is that helpful, Alan?
Very helpful. Okay, I'm going to do the second polling question just to get these pesky polling questions out of the way. So here's a good one. Have you in the past or do you currently serve as trustee or co-trustee of any trust, or have you walked on the moon? So have you in the past or do you currently serve as a trustee or co-trustee of any trust, or have you walked on the moon? So if you've walked on the moon or you've been a trustee or co-trustee, the answer is yes. If not, the answer is no. Or C, I have not, but am thinking about adding this to my practice. That's either walking on the moon or being a co-trustee. Okay. So.
And Alan, as Josh
Josh,
Cool,
what were
so,
the answers?
yeah, I would love to know the answer to that one.
62% no.
62% no.
Okay.
30, but almost more than a third are trustees or thinking about being trustees.
Okay, interesting. Well, that helps us as we decide kind of the tone to take for the rest of the presentation, because we do want to talk about, what a trust company does, what it takes to start a trust company, and if you are serving as trustee, some pointers of some things that you should be doing in your practice to protect yourself. And I remember, Alan, when I first started law school, going out and buying my Black's Law Dictionary. I don't know if you remember that. And I think everybody knows what a trust is, but I thought it would be helpful. Yes, yes. I still have mine. It's on my bookshelf over here. I think it's several editions older now, but I thought it was helpful just to go back to the Black's Law Dictionary legal definition of what a trust is. And most importantly, wanted to point out, I think we know this, but a trustee holds a fiduciary relationship to manage the trust corpus and the income for all of the beneficiaries, the current beneficiary, the remainder beneficiary, and being impartial to all the beneficiaries. So wanted to give the definition of a trust. And you can go on to the next one, Alan. Katie, you want to go over what it takes to get a trust charter?
Yes, this is, a lot of people don't realize this. So to be named a fiduciary, a true fiduciary in this space, you have to have been awarded a trust charter, which can be provided by a state regulator or a federal agency. And I know you have listeners on the phone in other states, but in Florida, our regulatory body is the Office of Financial Regulation. And that's for a state chartered bank here in Florida. And then nationally, the Office of Comptroller of the Currency is who issues national charters. It's an extensive application and review by that regulator. I talked earlier about identifying the market opportunity and assessing that market and building a business plan around it. It's a very detailed business plan that the regulator scrutinizes and then makes sure that we actually execute that business plan and don't do things outside of that business plan. And then there's a thorough background check and biographical and financial due diligence, including a complete personal financial statement, 3 years of tax returns, any entities that our directors or executives own, other LLCs, complete financial disclosure on all of that. So to be a director or an executive of a state or national charter is a very humbling experience because you have to reveal absolutely everything. Also, a lot of people don't realize that the regulator insists that there be a minimum capital at all times that is there to provide support in the event anything changes with the organization. And so that is an underlying capital and cash support that clients can rely on, that strength of the organization. And then the board of directors must own 25% or more of that capital. I think one of the most important things to note is that we have a rigorous and ongoing regulatory oversight. It started with our pre-opening examination, and then annually our Florida regulator completes a full safety and soundness examination.
Wow, that's a lot of paperwork. My gosh.
It is. We have lots of paper. Fortunately, we are very digital here, but it's an extreme amount of information that needs to be accumulated.
Katie,
Also, go ahead, Jim.
I was just going to add, as far about the 25% of the directors owning the capital, Katie and I were very diligent when we put together our board. and we looked at different characteristics that we wanted. We didn't just say, oh, we want all of our friends on our board. And so we knew the type of business owner, legal background, CPA, and we really made sure that we met all those different requirements. And you can imagine, so you go to ask the board, you know, we'd be honored to have you on our board. Here's what it means. And you have to disclose everything in your 3 years of tax returns and give us money. And during the de novo period, board members don't get paid. And so we have a very, very dedicated board that gives us a lot of great advice and support. We appreciate them. But I just wanted to point out that it's a lot to ask for a board member, a lot of responsibility and liability.
Excellent. You want to go to the next slide?
Yes.
Yes. And then Gentry touched on this. I'm so glad she mentioned it, but the board is really responsible for oversight of what we do. So we have different committees that meet either monthly or quarterly to ensure that we're reporting to them what's going on, and they have significant input in our direction. So fiduciary oversight, the investment oversight, which includes our investment management of our clients' assets as well as our own assets, audit and risk committee. We have a nominating and governance committee, and then of course a compensation committee. And then our management team is, we have a account acceptance committee that Gentry's going to talk quite a bit about later. We also have fiduciary decisions where we decide to accept clients, but also distributions, and then a very detailed investment review of our client assets. And those are at least monthly meetings, if not more frequently.
Oh my gosh.
So yes, more paperwork.
Unbelievable. Okay, I'm going to go back. I'm going to do another polling question. Please forgive me, but we're going to get them done early today. Okay. One of you want to walk us through this one?
Sure, I'll be happy to. So what is a Reg 9? If you've ever dealt with a trust officer or been involved in a trust company, you may have heard about we required to do a Reg 9. So as a Reg 9, the federal and state of Florida regulation requiring review of, I don't think all the answers got on here, Alan, but I can just read them. Review of all the policies and procedures, or is the regulation requiring trustee fees to be reasonable and appropriate? Or is it C, the federal regulation requiring review of assets annually to ensure that they are prudent and meet the asset allocation and needs of the trust account? Or is the regulation requiring trustees to follow all of their specific policies and procedures within a certain percentage? A, B, C, or D?
Is the answer E, all of the above, or what is the answer?
So I was going to wait and see if Josh can give me an idea of what everybody has picked.
C so far.
So far, C.
C, good. And C is C is the answer. So Reg 9 is a federal regulation. It is not a state regulation, and we'll talk about it a little bit more in detail in the presentation.
Wow. Okay. Fantastic. All right. So I want to make sure we have plenty of time to talk about your discussions with clients.
Yes.
And what you say in a conference room to a client. So do you mind if we skip some of this stuff and go to something that, you know, our viewers may think is interesting, like how are my great-grandchildren going to get their parole paid for? And how are they going to go to art school and just be artists all their lives? So where would I start for that?
I would go back to a little bit, no, sorry. It's probably slide 11 or 12.
Yeah, no.
Right there. Okay. This is, you know, different trust companies call this the spectrum. We call it the spectrum, the narrow to broad. This is looking at discretionary distribution language in a trust document, from the most narrow that says we can only distribute for emergencies to the very broad that just says we have full discretion to distribute to the beneficiaries for whatever reason. And so often we see in trust documents the standard that we probably all the viewers know as HIMSS: health, education, maintenance, and support, or sometimes it's an ascertainable standard that was actually defined by the Internal Revenue Code. But any language can be used in a trust document to give instruction to the trustee of what the grantor wants for their beneficiaries. And I've had many examples that we can discuss of where it's too narrow and it's just for emergencies only. And one example is recent that we've seen in the past few years with the pandemic. So often I see documents that say we can distribute as long as the beneficiary is employed, gainfully employed, because it sounds like a great idea. The grantor wants to make sure that their beneficiaries aren't spendthrifts just trying to live off of the trust account. But how many people lost their job during the pandemic? And that's something that grantor would not necessarily have expected. So if the document says we can't distribute if they're not employed, then we have to follow what the document says. And so sometimes language in documents can be too restrictive, even though the grantor had very well meaning in putting that language in. It just may not necessarily accomplish the goal that they're trying to accomplish. On the other side, we see full discretion where we can distribute for whatever, for the beneficiary's comfort, their happiness, for full vacation, whatever the beneficiary may want almost, even to the point of exhausting the trust assets with language that says my current beneficiary, my child, is the primary beneficiary, and the trustee does not have a duty to try to preserve assets for the remainder beneficiaries. And that gives us more discretion then to make sure that if the beneficiary wants to take a trip around the world, quit their job and take their kids, sell their house, and we're going to take a trip around the world and educate our children through travel, that would be something, if a very liberal language, that we can consider doing. So we're always balancing the different interests of the beneficiaries, and also the interest to make sure that the trust does last, because even with very liberal, even to the point of exhaustion language, we want to make sure that there's assets when that beneficiary reaches retirement age. So our job is a very difficult job, and we take it serious and looking at those documents. So I think this spectrum helps to kind of show the very narrow to the broad language. And I encourage attorneys and the CPAs on the phone, as you're working with attorneys through drafting clients' documents and planning with clients, to really talk to them about what they want, and not just use boilerplate language, or not just automatically use a HIMSS standard, but make sure that exactly what they want for their beneficiary so it can be accomplished. And if you're working with a corporate trustee, talk to the corporate trustee, share the document with them, so that if clients' goals are A, B, and C, that the language that you've drafted, that's the interpretation by the corporate trustee.
So Gentry, you have a client who's worth $30 million, and they're in their 70s. They have 3 children. One's a successful doctor, one's a school teacher, and one's an artist who's always between jobs. So when they die, they want to divide it into 3 shares, and they want to make sure that everything is nailed down properly to how they would have done it if they were still living. So what's your discussion like, and what's a common solution?
Well, I love what you said right at the beginning, is that they're going to divide it into 3 shares. What I do not like is what we call typically the pot trust, where everything is together. often people do that while their children are minors because that's kind of how we raise our children. So if something happened when they were young, they leave it together. But I have had pot trusts for adults, and that exactly as you described, with different income levels, different desires and goals, and it's very difficult to distribute. So I like the fact that you said to separate it into 3 shares. So that would be number one. And then it depends on what the grantor wants. I like lots of precatory language that says things like, I don't intend for my beneficiary to treat the trust as an ATM machine. I want them to be self-sufficient members of the community and give back to the community. These are the goals that I have for my beneficiaries, but I want the trust to be there to help support them and supplement their income. And, you know, if it's a $30 million trust, there's enough assets to be able to provide an extended vacation for the beneficiary. And so the more instruction that the grantor can give us, it makes our job easier than just simply saying, my distribute for the health, education, maintenance, and support for my child that's is a high income earner, or for my child that is a starving artist. Give us a little bit more detail. And Alan, some people put that in the document. I like to see it in the document, even if it's precatory language that just gives us some guidance. And other people I have seen do it as a letter of instruction to the trustee. So it's outside of the trust, but it provides more of the grantor's thoughts and what's important to them and the legacy that they want to pass on to the next generation. And the things that they want their next generation to strive for. And so it's easier for us if we do have that spendthrift beneficiary that is constantly coming back to say, here's the letter that your mother or your grandfather wrote to us and gave us very specific instructions. And so it gives us a little bit more authority when we're denying a request that just doesn't make sense. If it's a beneficiary that started their 3rd business and, you know, they don't really have a reliable business plan, they just have an idea, and money is quickly going out of the trust, to say that that's not really what the intent was. Is that helpful?
That's very helpful. I'm finding that a lot of clients will say, I don't think based on today's dollar and today's economy that any of my children should get more than $14,000 a year in support from this trust, adjusted for inflation. And my friends Mary and Bernie will be the trust protectors. So then the trust company says, sorry, here's your 14. Talk to Mary and Bernie if there's an issue. How does that work, or what? Tell us about, you know, different ways you see people do this.
So I have seen that, and if you're using a trust protector that can give us additional authority if it's required, it depends on what the authority of the trust protector is. You just don't want to tie the hands of the trustee to $14,000 a month, because what if there is an emergency? If there is a medical, you know, a medical emergency and something that insurance will not cover, but there is a experimental treatment that this beneficiary and their family has researched and really wants to try, then if the document says $14,000 a month, once again, our hands are tied. It's, you know, we can't do anything else. So that's why we like to have that discretion. So it's hard to, you know, if we had a crystal ball, it'd be easy to do estate planning, right, Alan? And it's hard to think about what the needs of our adult child that may be a very successful, you know, 35-year-old surgeon right now, but they may have something happen to them where they can no longer practice medicine. And so their needs could change 15 years from now. So it's difficult when we see something that restrictive.
Okay, good. And any other solutions that you've seen, or any other unique combinations of language or mechanisms that come to mind? Any stories that come to mind that are instructive on this?
Yes, well, I think, if we do have a document that is very restrictive like that, the good news is what used to be an irrevocable trust was it was irrevocable and very difficult to change. Now there are a lot of more opportunities to revise the trust, whether it's through a court modification or through a non-judicial settlement agreement. And the majority of states have some form of non-judicial settlement agreement statute that allows the beneficiaries and the trustees to enter into a formal agreement to modify the document within certain parameters. And so having that conversation with the trustee and the attorney to see if that's a possibility can get you out of some of those really tricky situations. And we've taken advantage of that often when we have very restrictive language and we're not able to meet the needs of the beneficiary.
So in other words, under Florida law, an irrevocable trust can generally be amended if everyone agrees to amend it.
Generally, yes. And that's important that everyone has to agree.
Right. And some of our clients have had us provide in the document that one of the beneficiaries will be a foundation established in Switzerland that will not be permitted to vote for a change. I don't know if it work. Yeah, we've had a handful of clients have us put that in the document because they don't want to die and then have everybody say, oh, well, this is what grandpa wanted, but let's all change it tomorrow.
Right.
I want to make it a little bit harder.
Right. Well, and so often if there's, depending on the family dynamics, even if it can be changed and everybody's consenting, if we're the corporate trustee and we have any concern about changes that are being made, we're not going to do that. We're going to go to court. We're going to make sure that there's a formal court modification that's completed.
Yeah. And then I see this next slide that you do have a nice example of bullet points for a client saying
We do.
Yeah, I like this. This looks really good.
We do, and we actually have a question on this, Alan, if we have time to, I believe, do we have a polling question on this one?
Yeah, it's the last polling question. We can do it now if you like.
Yeah, let's do it now, if that's okay with Josh, since we're talking about discretionary decisions. Oh, no, we have to go through the facts first, Alan.
Oh, okay. Let's go back to the facts. That's all right. Okay.
Yeah, so, there's a lot of factors that are considered in making discretionary distribution decisions. And I realize in the facts here, we're only giving you some, but let's consider that we have a $5 million trust for the benefit of Cindy and her 3 children. So Cindy is defined as the primary beneficiary, and she has 3 children that are 22, 18, and 12. And the 12-year-old has some special needs. So all of them are beneficiaries, even though Cindy has been defined as the primary. So we call that a sprinkle provision, that we can distribute income and principal to all of these beneficiaries. The trust is yielding about $150,000 a year, and principal and income are discretionary again for all 4 of these beneficiaries. So we've been providing $140,000 a year for Cindy's support. That's what she basically needs to help her meet her annual budget. She has a bachelor's in psychology and a master's in philosophy. The trust actually helped her with her master's in philosophy. And now she's requesting $40,000 in tuition and fees to go back and get her MBA. She thinks that having her MBA will make her more marketable because she wants to go back into the workforce when her youngest is 18. So she hasn't been working, and that's a great goal to have, is to get back in the workforce in a few years. The question is, based on these facts, should we make that distribution for her to go get her MBA? So Al, now you can pull up the polling question and we'll see what your viewers, how they would vote if they were serving on our trust committee. So A, would you make the distribution to Cindy so she can get her MBA? B, would it be no? yes for one semester and then see how she does, or D, you're going to call us and ask our opinion. All right, Josh, you'll just have to let us know what the majority is.
The vast majority is D as in dog?
52%.
52% say D. What's the second most one?
The second would be A.
A is the second one, yes.
Okay.
Which that's where I was.
Well, I think if you look at the vast majority, that just goes to show how difficult these decisions are and why we do have trust committee that meets regularly with, lots of different experience. Trust officers sometimes can have different opinions, and it's a difficult decision to make sometimes. Most likely we would do A as well, based on the language of the document. But one other thing that we didn't really talk about is the 12-year-old is a beneficiary as well and has special needs. So we would want to know more information about how severe those special needs are. Does the 12-year-old require some sort of medical attention? And we need to know a little bit more information about that because we want to make sure there's assets there. This isn't a very large trust that would be there to support him if he's going to need lifetime support.
What would you typically tell a family that they can expect this trust to provide? Do you use like a 3% rule so that you can say probably 3% of the value of this trust can safely be distributed each year, and that's going to go up and down as values go up and down?
So Katie, I've been talking a lot. Do you want to take this one from an investment perspective?
Yes, if the trust doesn't document it specifically, then we generally look around 3 to 4%. And over time, that should prove out to be okay. But as you know, Alan, there have been some very down times in the marketplace. And so, generally, all of our assets are invested because we do want them to be protected. But part of that protection is growth. And with growth-oriented portion of the portfolio, there is volatility. So yes, around 3 to 4%.
Okay, and then there's a lot of laymen on this talk, and what percentage is equities and what percentage is fixed income these days? Has anything changed in the last 50 years? Are there rules of thumb, and are there arguments with clients? And quite frankly, I know there are. People walk in and they want to be all in bonds. People walk in, they want to be all in blue chips, all in equities, all in utilities, all in preferred. So what's going on there, Katie?
I'll start out, Gentry, and then if there's anything I miss, help me fill in. Well, it's the best answer in the whole world. I learned it my freshman year in college studying finance. The answer to almost every question is, it depends. And I think that, what you're asking is the reason it depends, is because it depends on the family. We've got the ability to customize our investment portfolios and our investment recommendations based on the needs of the individual, either the individual or the individuals or entities. And so generally, I'd say we'd have a balanced portfolio that would, depending on the interest rate environment, could lean a little bit more towards equities or could lean a little bit more towards the stability of fixed income. And that 3 to 4% distribution that we talked about, right now where interest rates are, where short-term treasuries are over 4%, well, we can easily meet a 4% income stream for clients and not take any risk. When I say not take any risk, we could have all treasury bonds, short-term, let me catch myself, short-term treasury securities that are generating a 4 to 4.5 or even 5% yield. But with inflation the way it is, that corpus may not be enough for all the beneficiaries. and for what the grantor intended. And so growth is generally needed as a part of the investment decisions or investment allocation to ensure that those monies are staying ahead of, or at least in sync with inflation. So, you know, up until very recently, I would say over the last 10 years, these balanced portfolios have leaned more towards equities. Now with interest rates the way they are, I think you'll see, we're certainly seeing more of a shift that's appropriate and prudent into fixed income. So maybe back into the 50-50 or even 45 equities, 55 fixed income. Does that, yeah, it is. It's a very interesting time. And the key for us is to make sure that we keep these portfolios invested to weather through cycles. The last thing we'd want to do is build a portfolio in which when a dynamic changes temporarily, and temporarily could be 3 months or a year or more, but that we don't have to sell assets at an inopportune time.
Okay, my next question, when I started practicing in 1984, most investment advisors other than trust companies made commissions when they sold products. That's how the world worked. You went to the stockbroker, and the stockbroker recommended a stock or a mutual fund, and then they made a commission on the sale or a sale charge. And then this and the banks were the ones that had the fiduciary standard and charged a percentage of the portfolio, even back in 1984. Well, now most of the investment advisors I talk to say, yes, I'm doing this as a fiduciary. So what does that mean now? And how can I be sure they really are doing that as a fiduciary? I know there's a suitability standard, which just means, is this investment suitable without regard to whether it's in the best interest of the client? I think with a fiduciary standard, it's a much higher standard, but what the heck is it? And how do I know that the client has it?
Jessica, do you want to take that?
Well, why don't I take it and then you can add on, Katie.
Okay, happy to.
So I think, Alan, you're right. So often now investment managers are saying that they're investing as a fiduciary because they're no longer charging commissions, and they are charging a rate based on assets under management. But being a fiduciary is more than just how the fee is being charged. And I can't speak to what their practice is, each individual, and some of them may be acting as a fiduciary, but some of them still, just from a regulatory standpoint, do only have a suitability standard. As a regulated trust company, regulated by the Florida Office of Financial Regulations, we are the ultimate fiduciary. As Katie mentioned earlier in talking about risk management, we're under an exam every year, a safety and soundness exam, and the regulators making sure we're following our policies and procedures. Any even potential conflict has to be disclosed, and we cannot make any decisions as a corporation that would even come close to having the impression of a conflict with one of our clients. And so every decision we make, not just on fees, has to be with the clients, as we're stepping in the shoes of the client and making a decision that's in their absolute best interest. Katie, you want to add as well on investments or any other addition?
Well, I want to be mindful of time. The only word I'd add is that solely. We are solely interested in and make decisions solely in the client's best interest.
Great. Okay, let's go ahead and do a couple of questions from the audience now. And by the way, I think this has been a fabulous presentation, but I think we should do part 2, which is the client conversation. And I think we should do an hour of client conversations. If you could pull together 5 clients and just take us through what the client conversation is. And one with the client only and one with the client and her bossy husband, so that we could see how we handle that. So
Happy
here's a
to.
question. What do you consider to be the minimum amount for creating a trust for a non-special needs beneficiary to be managed by a trust company? As the balance of the trust declines, what level would you typically see that the trusts are distributed to an individual trustee, or that the trust is ended?
Well, that's a great question. I wish I knew where that viewer was located, because every state has a different statute on when a trust can be distributed when it becomes uneconomical. I'm seeing more attorneys drafting the document to distribute at $100,000 to either an individual or outright to the beneficiaries if it makes sense. We don't have a minimum account size. Many trust companies now won't look at anything below 5 million, and some are even going higher than that. Most certainly others are saying 1 million, but they really want to have a trust that's higher than the 1 million. It depends on what makes sense. We have a minimum account fee as opposed to a minimum account size. But once distributions are going out and the trust is really down below 250,000 in Florida, we have a lot of judges that will terminate that trust. If the beneficiaries, once again, not a special needs, no special needs beneficiaries are not spendthrifts, there's not any concerns about substance abuse issues or anything else, most of the judges that I've seen in the state of Florida will go on and enter an order to terminate that trust at 250,000. Is that helpful?
Okay. Yeah, very, very helpful. So Stuart, who's a very bright person and a long-term viewer, says, do you accept trusts from only Florida residents, or can people from anywhere open a trust with you? And secondly, does the trust have to say that its site is in Florida for you to serve?
That's a great question. So we are a Florida chartered trust company. So while we have clients throughout the country that have hired us for investment management or as agent for trustee, so they're an individual trustee in another state, but they want the support from investment standpoint as well as the operations, and to be able to provide the principal and income accounting, they can hire us as investment manager, and we can provide that principal and income accounting and the investment management for trustees elsewhere. But for us to actually serve as corporate trustee, it does have to be a Florida trust.
But a judge could convert it to a Florida trust, right?
Absolutely.
Go to court and say, Judge, we decided to make this a Florida trust. Judge says, oh, okay.
That's correct. And we've seen that happen a lot, Alan, recently, with the amount of people that are moving to Florida and they don't want to work with a trust company in New York or Wisconsin or wherever it was established by their grandparents. We're happy to talk to anybody and just give them some suggestions, and often you can have it converted by court order.
All right, so Gentry, here's one that I know we all cringe when we see a question like this, but it's a good one from Nancy. And that is, do you have suggestions for a response when a client wants to appoint a family member to be the sole trustee? You could probably talk a day and a half on that one.
Yeah, I do.
No, don't do it. Don't do it.
And it's hard. I mean, you know, when I was practicing law, I got this a lot as well. And there are instances that an individual can serve, but I tell clients it is a job. There are a lot of responsibilities that go with serving as trustee, from the legal requirements, the tax requirements, and just in the one case that we looked at today, how difficult it is to make some of these decisions on what's best when you have multiple beneficiaries. I did a presentation for the Florida Bar last year and had a co-presenter, and we talked to various litigators throughout the state, trusted estates litigators. So this was an unofficial poll. There was, we probably talked to 25 to 30 litigators, and consistently they said 80% of the litigation they do are with individual trustees. It's the individual trustees that get sued because they don't know what they're doing and they don't follow the requirements. and then the beneficiaries, which may be family members, get upset with them. And you don't want to have one person in the family serving as trustee and holding the purse strings of other family members. That is a disaster. I've seen it happen so often at Thanksgiving, and it's the number one thing, in my opinion, that can pull the family apart.
Yeah, I tell clients, if you don't want your children to talk to each other, make them share a trust or be trustees of each other's trust. That's the best way to completely ruin a family relationship. Now,
True. Alan, we had a cartoon in our presentation that was, a couple of people with all of this paperwork, and documentation is critical to avoid some of these pitfalls. And very, very few people understand or even know of the laws that exist and that must not just be done, but also documented over and over again.
the last question is from Bob, and he says, what about if a responsible child would be able to serve as co-trustee with their choice of any trust company? So the trust company would have to agree, maybe give them a choice of 4 different trust companies so they can't run them up too far. Does that work?
It does, and we're happy to serve, as co-trustee. I like to have some good language if it's us and an individual and we disagree, then we're in court, unless there's some language that says ultimately the co-trustee has the final decision. And some clients might not feel comfortable doing that, but it's back to having that discussion of, do you really want that individual, if they're serving as co-trustee, to have the final decision for all the reasons we've already talked about.
Right. Okay,
but that does give clients some comfort.
Yep. All right, well, Gentry and Katie, I can't thank you enough for that presentation. I'm really looking forward to part 2. And I want to thank all the participants, because we had about a 99% stay and watch level here. Normally at 50 minutes, a bunch of people drop off because they've had their 50 minutes, but most people stayed on. We appreciate that. And now on his horse appears Professor Jerry Hesh. Hi, Jerry, how are you? Okay, can Jerry hear us? Josh, call Jerry. Tell him he can't hear us. Gentry and Katie, any final words before we go on to the estate view?
I would just like to thank you, Alan, for giving us this opportunity to talk to your viewers. It was a lot of fun, and we're happy to come back and go through other examples or whatever would be helpful. And I'm looking forward to the rest of the conversation with Jerry. So I'm going to go on mute and listen. Perfect.
All right. Thank you so much. Katie, any final statements here?
I think Gentry said it best. We are very, very grateful. Looking forward to next time.
All right. Take care. Jerry, can you hear me? No sound yet, Josh. You could just put him on speakerphone on my cell phone if you want. The audience will never know that that's what we're doing. All right, so I'm gonna start talking about the Estate View software while we wait for Jerry's sound to work. Estate View is a computer program. It is web-based, but it will work on your computer or your iPad or even your phone and your Apple computer. And it allows you to put in various values. For example, Peter and Mary Jones here have $35,500,000 of investments, a $3 million residence, various growth rates, a certain amount of income they're sharing each year. And with no planning, if the first spouse dies in year 11, second spouse dies in year 19, you've got an estate tax of $27 million. But if we fund a credit shelter trust on the first death, then the estate tax goes down to $23 million. Or if we rely on portability instead, we have a $26 million estate tax if portability applies, but if portability doesn't apply because of a remarriage, we've got a $32 million estate tax. So I'm going to go with the bypass trust. And should we put the house in a qualified personal residence trust? And if we go ahead to qualified personal residence trust down here, then if I have a 10-year Cupert, then you see that I'll have over 7 million escape the estate tax on the second death. But if I go too long with the Cupert, and it may fail. So I'm going really quickly here just to show you some things that Estate View does. What if this couple wants to engage in annual gifting and they have 3 children and they gift 17,000 times 3 times 2 spouses while they're both alive, and then 17,000 times 3 growing with inflation after the first death? Well, now the gift trust will have, look at that, $5,300,000 in it. And what if they gift discounted LLC interests instead of just cash? They could gift LLC interests, taking a 35% discount, say, and now the gift trust is going to be greater. Then they could do a life insurance trust. We could talk about getting life insurance out of their estate. And then finally, an installment sale, which could really reduce their estate tax to 0. There's Jerry. Hello, Jerry. How are you?
Good to see you.
Good to see you. I'm just doing a real quick walkthrough. Or if the installment sale is not of interest or a smaller one, they could do a charitable transfer on death. So instead of 88 million to the children and 20 million estate tax, if I go with charity, it is 58 to the children, but 0 estate tax and 50 to the foundation. And if I could do a charitable lead annuity trust, going 60% to charity, 40% to the family, now the family is at 78 million, the charities are at 20 million. So that is the first Estate View mode. And I think, Jerry, you've seen this mode. The only thing, go ahead.
Let me do an introduction. Okay. When we do estate planning designed to shift value to an irrevocable trust without any gift and not have the trust be exposed to estate tax, there are 4 different factors that enter into the equation. One is you first determine the discounted value of the interest, because we always transfer non-voting interest and we try to put the asset into a LLC or partnership so it has lack of control or lack of marketability. So the first factor that we consider is the discount. The second factor we consider is if we're going to sell that discounted interest to the grantor trust, we're going to do a promissory note using the AFR. And the key here is if you sell an asset, say at the 4% AFR, and the asset that the trust purchased earns 6%, that 2% spread, the trust keeps the difference. So the second factor is what we call the use of financial leverage, borrowing money at a low rate of return and investing the loan proceeds at a higher rate of return so you can keep the spread. That's the second factor. The third factor is the fact that when we sell the asset to the grantor trust at its current discounted note value, the trust now owns the asset, and therefore all subsequent appreciation in the value of the asset is going to be owned by the trust, because if the trust buys an asset for $1 million and the asset that the trust purchased increases in value to $1.2 million, the increase in value is now out of the estate. And that third factor we call the freeze. Then there's the most important factor, which is rarely addressed by most people, and that is the income-producing asset is now in a grantor trust. So even though the grantor trust is a separate taxpayer for estate and gift tax purposes, for income tax purposes, the trust is ignored. So what that means is, for income tax purposes, the taxable income earned by the asset that the trust has just purchased is all reported by the grantor, and the grantor has to pay the income taxes. So let's take a simple example. I loan $1 million to my grantor trust at 4% interest. And the grantor trust invests the $1 million at 6%, or earns $60,000. And then the grantor trust pays the grantor $40,000. For income tax purposes, the sale is ignored, because for income tax purposes only, the grantor is deemed under an 85 revenue ruling to own all the trust assets. So what that means is the loan is disregarded for income tax purposes. So no interest income and no interest expense deduction is reported, but the grantor gets $40,000 as interest payments, but the grantor has to report as taxable income $60,000. So that fourth factor, which we call the burn, enters in. And the key is, in the beginning, the spread isn't that much. But as the trust keeps reinvesting all of its assets and the trust income keeps growing, that burn that the grantor has to pay by reporting the grantor trust income can be very significant. And the key is, all four of these factors enter into the transfer of wealth. However, here's the problem. How are you going to explain all that to the client in an understandable manner? So what Alan has done is designed a spreadsheet which has all of the examples, which shows you the financial impact of everything. But the key is, when all these factors work together, the initial objective has to be fine-tuned, because you're going to assume various assumptions on these four factors, and when you illustrate it to the client so they can kind of understand it, they can say, wait a minute, there's a point in time where the trust is going to have more assets than me, and I don't want to pay the income taxes on that. So you might say, well, wait a minute, let's do some things to mitigate all those factors. So you can change all of the assumptions. For example, instead of, if you have $10 million, if you have like $20 million of assets you want to do estate planning with, maybe you'll figure out of that 20 million, maybe I don't want to do the estate plan for all 20 million. I want to keep 5 or 6 million to be able to provide me with the ability to pay all the income taxes on the grantor trust income in the future. So what Estate View allows you to do is put in the assumptions for every one of the different factors, see how they play out, and then with the client, you can change some of the factors. For example, you might want to increase the interest rate on the note, just so the grantor gets more money back to pay the burn. Or maybe you want to turn off grantor trust status in the future. These are all the subjective factors that go into the custom design of an estate plan, and without the ability to illustrate it with simple to follow numerical examples, it becomes extremely confusing for the client. So what we're really doing here is designing a program that allows you to change the factors to figure out the optimal structure, how much you're going to sell, how much you're going to gift, how much you're going to keep, what interest rates, and all the other factors. And then basically custom design it so with the client, so you can show, oh, what if you assume the asset's going to increase by 8% a year? And the client says, well, I don't think I'm going to get that. Maybe my asset's going to increase by 3% a year. So you basically, using the spreadsheet program that Alan has developed, okay, and I've just given him comments. I wasn't there for the day-to-day nitty-gritty, is how to look at all these factors, how to communicate them in an understandable manner to the client using numerical examples, and then fine-tune it so you can not only maximize the tax savings, but achieve the client's financial objectives as well. And that's really what Estate View is doing. Okay, Alan.
Thanks, Jerry. So let's look at the self-canceling installment note module here. And what I have across the top is a client age 49, and he will make a $1 million gift to an irrevocable trust for his spouse and descendants called the Spousal Limited Access Trust. And then he will sell $10 million worth of investments to this trust, and he would like to use a note. So the note can either bear interest at 3.75% if it's this month. Next month, it would have to be just about 4%. And then if he would like the note to cancel on his death and not be in his estate whatsoever, he can use a 2.3726% interest premium. So the total interest rate payable to him would be 6.122%. So,
Alan,
yes.
Alan. So basically, most people, when they do installment sales of the grantor trust, they want to maximize the wealth shift and the financial leverage. So they always use the AFR. Okay? And you're telling me I'm going to increase the interest rate on the note by another 2.5%. And why? But here's the key is, what's the advantage of increasing the interest rate from a financial perspective? Number one, the grantor says, wait a minute, I don't want to pay all the interest I don't want to pay all the income taxes. I want more money coming back to pay the income taxes on the grantor trust burn. So you can increase the interest rate on the note. The AFR is just a minimum interest rate you can charge. And the Internal Revenue Code under 163I says we will respect the note if you increase the interest rate by 5 percentage points above the AFR. So if you wanted to mitigate the impact of the burn and you have a 4% AFR, you can have a promissory note for 9%, so that you can basically, the grantor doesn't have to pay all the income taxes. This grantor is healthy. It's a young person, expected to live a long period of time. And what Alan is showing you here, because the risk premium, the increase in interest rate that he has illustrated here at 2.37%, that is the premium that you can put in and have the note be self-canceling. And the business reason for it is just to give more interest back so the grantor can pay the burn. But look, most people use self-canceling installment notes for people who are expected to die within a short period of time. We don't expect this individual to die. We expect them to live a long period of time. And since we're increasing the interest rate for a financial reason, throw in the self-canceling feature on the note, because there's always a probability that a healthy individual will die prematurely and get an estate tax home run. And when the IRS doesn't like skins, because every skin that the IRS audits, the individual died within a short period of time. And they say, you're only doing this for estate planning, it's a scam. Well, here we're doing it for a business reason, for a healthy individual. We hope we never have to take advantage of the self-canceling feature, but if they happen to unfortunately die early, it becomes an estate tax windfall. And the IRS can't challenge it because it was healthy and there was no indication that they were in poor medical health. So, and now you can then go back and illustrate all the number crunching by explaining why you would do a skin for a healthy individual. Back to you, Al.
That's right. So just to go through the settings here, I'm on the basic setting and I'm on the first skin and I'm using the 75/20 rate of 5%, which is automatic. It seeks it from the internet and tells you. My client is 49 years old. According to the IRS tables, he can live 32 years, so I can safely go to 32 years on the balloon, so I went to 31. If I go to 33, I get a warning light, and the IRS thinks if you go past the life expectancy that it may be treated like a private annuity, which has implications.
No, not like a private annuity. It looks like if you go beyond the life expectancy, it looks like you retain the right to the income from a trust substitute for the rest of your life. So, yeah, that's the reason for it. And the IRS, in some of the early skin decisions, basically said the skin is nothing more than a trust substitute where you retain the right for income for a period which did not, in fact, end to your death. Now, those cases where the IRS argued it, the tax court rejected it, but we, out of an excess of caution, we don't like to go beyond life expectancy.
Got it. So I'm showing that if the client, based on all these assumptions, if the client lives to year 32, the estate tax savings are $7.9 million at a 3.75% AFR. If it goes to a 4% AFR, because he closes this next in September in 2 weeks, it's just a little bit less tax savings because his estate is going to be a little bit larger. So I can either mark up the interest as we're showing you, or alternatively, if you want to keep the interest rate at 3.75, you can mark up the principal. So the principal in the note, instead of being 10 million, would be 15 million. So that's a pretty large principal markup, but that is one of your options under the law. The only time I've ever marked up principal is when I would have a usury problem because the client's old and you would be above the legal interest rate. Go ahead, Jerry.
Here's the key in this situation. This is a sale to a grantor trust. So the sale is ignored, just like an installment sale to a grantor trust is ignored. The problem is the commercial programs only have the illustration for taxable sales. And they don't really tell you anything about the burn, because what we're doing here that the commercial programs do not do is show you the impact of the grantor paying all the income taxes on the trust income. And when you look at a long period of time, the key here is the most important wealth depletion factor is the grantor paying the income taxes on the trust income, because every year you can see the assets in the trust and the trust income increase. And towards the end, later years, you can see how large it is.
Right. So, Jerry, what I have here is a column in the spreadsheet now that says savings from the burn based upon Jerry dies. So the savings from the burn in this situation would be $1.9 million, and that's based just on paying income tax of 37% on 2.4% of the portfolio each year. And you can, of course, adjust those numbers up and down. So then going back over my inputs, I've got a seed capital gift of $1 million, which you could be in cash or whatever you like. And then I've got the contribution of 10 million, but this assumes no discounts. So this would be $10 million in stocks or bonds. Now, the client says, how much would I save if I put it in an LLC and a month later contribute a 99% LLC interest? Well, I'm going to hit duplicate here. And now I have two skins. The first skin and the second skin are identical, but I'm going to change one thing in the second skin, and I'm going to go ahead and take a discount, and I'm going to take a 25% discount. So with the 25% discount, my sale value is only 7.5 million instead of 10 million. So now my annual payment back out of the trust is much smaller. My note is much smaller, and my estate tax savings are twice as much from taking a 25% discount. That sounds like too much savings. To be honest, I'm going to have to check the math on that, but it certainly demonstrates that the discount here is very, very important. And
Alan, I have a question for you. Most estate planners, when they basically talk about an estate plan, the first thing they talk about is discount, the discount, the discount. That's the key, all right? And what we show you is the tax savings from the size of the discount is almost de minimis, because look at the tax savings from let me ask you a question. If the IRS on the discounts usually offers like 15, 20, or 25%, and if you take a discount in the 35 to 40% range, and you also have somebody who takes a discount of 25%, what's the likelihood the 25% discount will get audited as opposed to the 35% discount?
I would say pretty small.
Much less. And remember, the client is telling you, I want to be as aggressive as possible, but tacitly they're also saying, I don't want to get audited. And so if you compare a 25% discount to a 35% discount, and you see that the savings just from the discount is de minimis, maybe you say, hey, why don't I take the 25% to significantly reduce the audit risk?
Right. Now, Jerry, I'm going to show you a third scenario by clicking duplicate again. And the third one is just like the second one, except a lot of the spreadsheets we see are flawed because a lot of clients own businesses, and what they tell me is the business is worth 10 million, plus it shoots off $400,000 of dividends every year. So I want to show that we're shifting $400,000 of cash away from the client's estate and into the trust estate. I'm going to go to the annual additional income and just click up to 400,000. And now my estate tax savings are double. So when you illustrate the actual cash flow on the spreadsheet, you see a big difference. Now, I'm going to go to general explanation now, and I would like to see PowerPoint slides summarizing those three scenarios.
Wait a minute, Alan. When typically when the average person advisor does an estate plan, they explain it all, and they basically then have to go and create some slides using PowerPoint to do all that, and that's extra work, right?
A lot of work, to be honest.
A lot of work. And you're telling me that by putting in all these factors, it will automatically generate a slide presentation for you?
Yep. Yep. I clicked, show me skin 1, skin 2, skin 3. Give me a checklist, give me a general explanation, and give me a PowerPoint presentation. We're going to call them Jerry's PPT or SCN. Click submit, and there they are. There's PowerPoint 1, 2, and 3 for the 3 skins. So I can open the PowerPoint. We're still improving the PowerPoint, and it's editable. And there it shows, let me fix my settings here, which are all perpetually wrong. So first, the grantor puts $1 million into an LLC. Then the grantor keeps the voting member interest, transfers the non-voting member interest to the trust after making a seed capital gift, gets back a $7.5 million note. So you can explain it to the client. You can remember what you were doing here. It knows if you use discounts or if you didn't use discounts. And then it gives you the spreadsheet as well. So we're still working on it. We're still improving it. It still has issues, but it's going to be, it's already, saving our firm a lot of time. By the way, if you're on Google Chrome, in order to find those PowerPoints that I just saved, I've got to go to the top right-hand side to the arrow pointing down, and then they all come up on my screen, if you can see that. There you see it. So Jerry, any questions?
When I saw there were 6 things there, 3 of them were PowerPoints, and there were 3 Word documents. What's that?
There's a general explanation that spits out that explains it. There's a short explanation that explains it in the exact numbers. There's a checklist, and then there will be sample self-canceling installment note provisions that our law firm has drafted and uses.
So that means, in addition to having all the spreadsheets and PowerPoint slides that you can use to explain it, it also has a memorandum that drafts everything and explains it in a written document.
That's right.
Automatically?
Automatically, with pointers for the planner.
Wow.
With cautions and pointers.
So that's unbelievably time saving. How much time do you save?
We save a lot of time.
Wow.
We do save a lot of time. I could
does
show you, yeah.
How much does the state view cost?
We haven't decided yet. How much do you have? The first year, I expect it to be very inexpensive because I want to have a lot of users. And whether we increase it later, we'll just decide as we go. But I think it will have a lot of value for a lot of planners, that's for sure. It's already almost, it's almost paid for itself for us, just with our ability to illustrate for clients and have them understand what we're doing. I want to.
And the key is you also it does the first draft of the memo where you explain everything in writing.
Right.
So that's all.
That's right.
Does any commercial program do this?
No, not that I'm aware of. So, Jerry, there's another feature we just added, and that is I can get this set up to what I want it to be for this client. And then, of course, I found that we can just do a 10 or 15-minute video for the client themselves, and I'm talking to the client and I'm explaining each of these things, and I'm explaining what I want to do. I'm explaining how the software works, and then I want to share it with them. I want them to be able to run the numbers, and a lot of clients have enjoyed running the numbers. So I click here on Generate Client Letter. oh, let me go here. I click on generate client letter, and then I'm sorry, not generate client letter, share with client. I click on share with client. Now the client's code is going to be 745157. So I'll send them a text or I'll send them an email telling them to open this and put in their code 745157. I click generate client RL. I click copy to clipboard. And now all I have to do is copy and paste that into an email and email it to the client. They can click on it, put in the code, and now they have access to the software for 2 weeks with their names on it and not modifiable as to their ages or the applicable federal rate. So we found that they really enjoy playing with it. Jerry, what else would you like to see or illustrate?
The most important point is, with every successful estate plan, it can become too successful. And there is a point in time in the when you show the client how all these 4 factors shift wealth. And remember that not only do you shift wealth, but because the grantor has to pay the income taxes on the grantor trust income, that is a tax-free way, gift tax-free way of further depleting the grantor's retained assets. So what you want to so the grantor, remember, says, hey, I'm 65 or 70 years old. I'm going to live tonight, and I'm going to live into my 90s. So you basically want to show the grantor that if they're going to live into the 90s, how much of their assets they should retain so that they have enough to live on to pay their living expenses and comfortably pay the burn. And so basically, can you bring up the simple, straightforward installment sale to a grantor trust? Or actually, Alan, yeah, okay, bring up the installment sale to a grantor trust.
This is, oh, I'm sorry. Share my screen. There you go.
All right. Okay, now, what we have here is, you notice there's 2 columns. One is the asset. In this situation, Alan, what was the total amount of the individual's investment assets?
25 million.
Okay. And so if they make a gift in trust and then do an installment sale, would you basically, deplete all 25 million through a gift and installment sale? The answer is no. So what we want to show you is, can you basically change the individual's income producing assets from 25 million to 50 million?
Sure. Let's click on 50 million.
All right.
Got it.
And basically, let's suppose they make a gift in trust of 10 million.
Okay. A seed capital gift of 10 million.
And they basically, so that leaves them with 40 million. And
Yep.
out of the 40 million that they have left, they do an installment sale for 20 and keep 20 million.
Okay, so they put 20 into an LLC. So I'll move this up to 20. Put 20 in an LLC. Oh, hold on, sorry, I put 2 million. Yep, 20 into an LLC. They take a 25% discount. So let's see here, move it up a little bit to 20, and it's a $15 million note. Then the interest rate, what sort of,
Use 4%.
okay, 4% rate. Got it. Oops. Oh, 42%. That wouldn't be very good. Okay, 4%.
Okay. And now how old is the individual? Let's say they're 65.
Yep, that's
All right,
good.
So let's do a 20-year note.
All right. Got it.
But let's extend the projections to 25 years, to age 90.
Okay. Got it.
So now, Alan, the key is if they live to age 90, oh, by the way, how much are their living expenses?
Oh, that's a good one.
We forgot to put that in.
You want to say 500,000 a year?
Yeah, 500,000, it's fine.
Yep. Got it. And you want asset growth at 8%, or you want to go to 7%?
No, let's use asset growth at 6%.
All right.
And let's increase their living expenses by 2% a year, which you have.
Yep.
Okay. So the key here is if you go out to age 90, how much are they left with?
26 million.
They're left with 26 million?
Yep, that's what it says.
Wait a minute. Hold on. They had 50 million. They made a gift of 10 million. They sold 20 million. And they're left with 26 million at the end of it.
That's what it says. I can export this to a spreadsheet for you and send it to you.
Well, don't send it to that. What I want to know is with the, it's hard to see that here.
Yeah.
But you know, the point is that when there's a point in time where the grantor trust treatment is going to be depleting their retained assets, and it compounds, so it becomes very significant in the later years.
Yeah, it's over $1 million in 2036. It hits $1 million a year. It's $1.4 million in 2047. So it is a big number.
It's a big number.
I think there's, yeah, I think I know there's, I think that the flaw in this that I'm going to have to fix is that it's giving a 6% rate of return on a 4% note. So I've got to fix that. I think that's what happened.
Well, so the point is that when you run this out to age 90, because remember, life expectancy for someone age 70 using the mortality tables is 15 years. But all that means is there's a 50% probability they'll still be alive at the end of 15 years. So you have to always take your projections out to the age they actually think they're going to live to. And the point is, when you see how much the grantor trust is depleting your assets, you might want to say, instead of selling 20 million, maybe I should only sell 15 million. Because you always want to retain, enough assets to pay the burn and still have enough to feel comfortable with. Because remember, at a certain point in time, the note's going to be paid off.
Right. Right. So Jerry, we are now showing the burn when we, on each calculator, when we go to advanced and we ask, is the grantor paying the income taxes? And then that, when we put yes, then it does show the burn when we load everything up. So that's working well.
Now, let me ask you another question now. Let's suppose, for simplicity purposes, the grantor loans $10 million to the trust at 4%. So that's $400,000 a year of interest. And the grantor invests the $10 million at a 6% rate of return. So the grantor gets $200,000. Okay? So the trust earns $600,000 on the $10 million loan, pays $400,000 of interest on the $10 million loan. So the trust nets $200,000. And the trust doesn't pay any income taxes on that $200,000. So the trust has $200,000 of extra cash. Now, suppose you have an individual who wants to fund a life insurance policy with premiums of $100,000 or $125,000 a year. Now that's a lot of annual exclusions. In that hypothetical that I just gave you, you lend $10 million to the trust at $400,000 of annual interest. It earns $600,000. You pay $400,000. The trust nets $200,000. Doesn't pay any income taxes. The trust has $200,000 of extra cash. Can it afford to pay $125,000 of annual premiums on a policy without using annual exclusion gifts?
By split dollar?
Just normal. It is a split dollar transaction, but the key is if you want to fund large life insurance premiums, you don't have to do that with annual exclusion gifts or taxable gifts, because the spread each year in the estate plan provides the extra cash to pay those large premiums. And the key is, if the grantor nets $200,000 of cash, it doesn't pay any income taxes on it. So the after-tax amount that the grantor trust nets is $200,000, and that can be used to pay life insurance premiums.
Beautiful. Yep. Someday we'll be able to illustrate that. Should I try your $50 million thing here on this module now? So
Okay.
let me see, where's my investments? There we go. So I put investments to 50 million. Well, let's go to the Cupid instead. I just want to show you the Cupid. So Jerry, where are you when a client has a $40 million net worth, and nowadays all these houses are worth $5 and $10 million?
That's a problem.
Yeah.
Because now, so you basically want to do if you want to do a Cupid, remember Cupids have certain restrictions. One of the problems with a Cupid is if you die during the term of the Cupid, remember you're able to live in the house for a fixed number of years, and the remainder interest is a gift to your children. But after that fixed number of years goes by, you don't have any right to live in it. So then you got to rent the house back from the trust. And if you go out too long, there's a risk you'll die early, and then the whole house will be included in your gross estate.
Right.
So you don't want to do Cupid terms for too long and increase the probability you might die during the Cupid term.
So here I've got a 49-year-old And I see here that if I go with a 20-year term, according to the mortality tables, there's an 84% chance that he'll live that long. But I know he's wealthy. He probably goes to doctors and listens to their advice better than average. I know that he's not obese. He's not a smoker. So maybe are you comfortable going 20 years in this situation?
For someone age 49,
Mm-hmm.
with a probability of 85% they'll still be alive, of course I would.
Yeah, yeah. Okay. Well, how far out would you go? Would you go 25 years?
Well, look at the probability of him being alive 25 years from now.
It is 75.25% according to standard mortality tables.
And we know they're going to live a little longer. See,
Right.
the problem with a Cupert is most estate planners will have relatively short periods of retaining the right to live in it, because they're risk averse, and they don't want to really have a risk of you dying during the term. So they tend to be very conservative on what we call the length of the term. They like shorter terms because it reduces the risk. What Alan is showing you, when you look at the real numbers, the risk is not that significant if you go out 25 years for someone that age.
Right, right. But what I could do here is I can queue this up and I can say to the client, here's a 20-year Cupert. If you live for 25 years, the estate tax savings is $8,000,001. So that's Cupert number one. And by the way, I can program what I'm showing them in the data. So, but anyway, that's Cupert number one. Now, then I can show Cupert number two and just change one thing, 25 years. So that's Cupert number two. And I see the gift on Cupert number one is $1,581,000. The gift made in Cupert number two, going 5 years out, is a little bit less, but it's only a $450,000 difference. The estate tax savings is very similar. But then I might do Cupert number three, which would be, are they going to use discounts? So maybe what I would do is have each spouse do two Cuperts, maybe half of your house to a Cupert for one child, half of your house to a Cupert for the other child. And I'm going to assume that I could take a 15% discount if I do that, which is that's probably about the discount you can get. By the way, Jerry, if you click up your discounts too high, the computer always warns the user, wait, you went too high on the discount, come back down. So there's a few other guardrails that we're designing that are pretty fun. But with this number three, now my gift is down to $944,000, so my estate tax savings are greater. And by the way, I can also show these three Cuperts in terms of the percentage of the value that's going to be out of the estate and the risk of dying during the term. So that's that can be shown. And then also, because I'm showing the rent that would be paid each year after the Cupert term for the right to use the house, here we're able to illustrate each Cupert with the rent amounts on all three scenarios, and then the portion subject to estate tax. And then, of course, we click there, click on all three Cuperts, and I might want the PowerPoint presentation and the checklist. Click on Submit. There they go. Click there, open my Cupert PowerPoint. There she is. Enable editing, slideshow from beginning, display settings. Yes, you have to have a master's in science degree to do any of this stuff nowadays. There it is, swap presenter. And there, this particular Cupert was the 5 million. Reportable gift 944, 3% growth I'm showing. So this gives them the explanation and gives them the numbers. And then also does explain a separate Cooper to each separate trust and the discount possibility. So that's that part of it. Go back to close. Jerry, anything else you'd like to see? We're going to go over private annuities next week. We're going to do installment sales and private annuities. So this is the calculator for that, of course.
Well, the most important point is all the factors that enter in, we can actually illustrate them, and you can change them, and it's just a more efficient way of being able to explain the planning proposal to the client, where they can see actual numbers, and then working with the client, you can change the different assumptions and decide, because the most important point is how much of your assets you want to keep in reserve in your own name to be able to pay the income taxes on the grant or trust income, because that's going to be slowly depleted. And there's a certain level, even with someone with $50 million, they're not going to commit all 50 million. They're going to keep 10, 15, 20 million. So you basically want to give them that level of comfort.
Right. All right, Jerry. Well, thank you so much for joining me. Thank you for the surviving viewers, all 96 of you. Thank you for everyone who's trying this software. We do have quite a few weeks before it's going to be done. It's a lot of work, but it's a lot of pleasure as well. Jerry, what are you doing the rest of the day?
Actually, I have to, for Notre Dame, I have to do a special report for the certified financial planners, because for everybody else, the accountants and the lawyers, all you have to do is give them the topic descriptions. But the CFP says topic descriptions don't fit our model. What you have to do is first list what are all the learning objectives, and then list how you accomplish those learning objectives. Even though the topic description describes it all, if you don't put it in their format. So I have to do that this afternoon.
I think that's something that artificial intelligence will probably be able to buffalo regulators in the future for that.
I hope so.
Yeah. All right. Well, thanks again, Jerry. It's great, as always, working with you and playing with you.
All right, Alan. Take care.
All right. Take care, everybody. Thank you, Josh. Yeah, I had some malfunctions there.
All right. I'm leaving.
All right. Take care, Jerry.
Closed out for me, it didn't close you out. That's weird. Okay, so.
Yeah, boy, I had some software malfunctions.
Did you?
Yeah.
His camera looked good.
Yeah, was he happy with the laptop?
He was confused about it.
As to how to use it?
Yeah, because he doesn't have Wi-Fi. So I had to talk him into plugging in a direct internet cable to it.
What is with Kevin, man? Can you set me up on another one?
Yeah. Oh, I just do it right here. It's easier if I just do it here.
Hey, who is that out there?
First time I ever did it.
Are you getting going?
What?
Are you still here another? Oh, can you show me what you did?
Yeah. I was stuck analyzing some of the cases. Some of them were actually irrelevant to the valuation of Crotty, but I did some of the summary that you